Welcome to The Explainer. Today, we're jumping right into one of the wildest valuation puzzles in large-cap pharma right now. I mean, if you follow the healthcare sector, you already know AbbVie has been pulling off this massive, high-wire transition, trying to navigate that dreaded Humira patent cliff. And they've done it brilliantly. But right now, the stock is throwing off this profound mystery. It's a true valuation paradox that has Wall Street completely split.
So, here's the intense cognitive dissonance we're dealing with. How on earth can a single stock be viewed as nearly 50% undervalued by one standard metric, and yet at the exact same time look like it's priced at double the valuation of its closest peers by another? It kind of makes your head spin, right? Well, that's the core mystery we're unpacking today to figure out which camp is actually right.
The sheer scale of this disconnect is what makes it so crazy. Look at the two-stage discounted cash flow model. The one that looks at the actual hard cash the business generates. It spits out an intrinsic value of roughly $440 per share. But then flip over to the classic price-to-earnings or PE ratio, and wow, it's sitting at a staggering 70x multiple. So the cash flow model is practically screaming, hey, massive discount here, while the earnings multiple is flashing bright red warning signs that the stock is wildly overvalued.
Let's pop the hood on this cash flow machine and interrogate the bull case first.
AbbVie is running on an absolutely incredible growth engine right now. In Q2, they posted a massive $16.99 billion in revenue. That's up over 10% year over year, totally beating expectations. Management even bumped up their full-year guidance to roughly $67.6 billion. And the undeniable stars of the show here, Skyrizi brought in $5.5 billion. That's a 24% jump. And Rinvoq pulled in $2.5 billion, which was also up nearly 24%. I mean, these two immunology blockbusters alone now make up more than 47% of AbbVie's total revenues. They've essentially replaced those lost Humira revenues, and combined, they're on track to deliver over 20% growth in 2026. But the absolute crux of the bull case boils down to this staggering number, $20.1 billion. That is AbbVie's annual free cash flow. When you are raking in tens of billions in pure cash, you are literally a cash flow machine. Project that $20.1 billion out into the future, and that's exactly how the DCF model gets us to that $440 intrinsic value. So, with the stock currently trading somewhere in the $240 to $250 range, value investors are staring at a massive 48% discount to fair value. That's a margin of safety you just can't ignore.
But there's always a but. Let's shift gears and look at the earnings disconnect to figure out why the bears are getting so much sticker shock. Here is the harsh reality on the other side of the coin. AbbVie is currently trading at a PE ratio of about 70x. Now put that next to the peer average, which is just 20x, or the broader biotech industry average sitting around 16x. Even if you use models that generously adjust for growth, margins, and risk, the estimated fair ratio for AbbVie is only around 37x. So purely on an earnings basis, you're paying roughly double what the fundamentals suggest you should be. It is priced for absolute total perfection. Which brings us to the ultimate question you've got to ask yourself. Which yardstick is the right one here? Do you look 5 to 10 years down the road at a cash flow horizon just overflowing with tens of billions in free cash? Or do you look at the immediate reality of today's profitability and think, why on earth would I pay a 70x multiple right now?
To answer that, we really need to look at how management is defending their economic moat and what curveballs might be coming their way.
A huge test of this moat happened back in March. A new oral competitor jumped into the psoriasis market, and the immediate fear on Wall Street was, oh no, this is going to eat into Skyrizi's massive market share. But it didn't. Management reported absolutely zero degradation in new-to-brand prescription trends. Actually, scratch that, Skyrizi's prescription growth accelerated despite the new competition. Basically, management's take is that the new drug just expanded the overall advanced therapy market, instead of stealing AbbVie's slice of the pie. That is a textbook defense.
But there's a pretty wild curveball clouding the pipeline right now. AbbVie has some major assets in development for a really painful skin condition called hidradenitis suppurativa, or HS, but analysts are pointing out this fascinating risk called the GLP-1 effect. Since those massively popular GLP-1 weight loss drugs actually reduce inflammation in the body, there's a real fear that patients in the placebo arm of AbbVie's trials who just happen to be taking GLP-1s for weight loss might see their HS symptoms improve anyway. And that could artificially inflate the placebo success rates and totally muddy the data on whether AbbVie's drugs are actually doing the heavy lifting.
Now, management's defense against this is pretty rock-solid logically. They argue that because their trial sizes are so massive, any positive anti-inflammatory effect from GLP-1 drugs should hit both the placebo group and the active treatment group equally. So mathematically, it should just cancel the statistical noise out. It makes total sense, but let's be real, this mystery won't be definitively solved until we actually see the data readout.
So how is Wall Street reacting to all of this, and what else is fueling that growth pipeline?
Well, the smart money is definitely making its bet known, and it's a bullish one. We're seeing an absolute institutional buying spree. Envestnet bumped up their stake by 7.6%. Mission Wealth Management literally more than doubled their holdings, and Vanguard added even more to its already massive position. Wrap all that up, and institutional investors now own over 70% of the company. That is a huge vote of confidence. And the analyst consensus totally matches this vibe. It's a solid buy right now, with average price targets around $278 to $279, and some bulls aiming as high as $295.
And AbbVie isn't just resting on its laurels here, they are actively buying future growth. Right now, they've got a $10.9 billion acquisition of Apogee Therapeutics pending. This is a highly strategic play designed specifically to beef up their late-stage immunology pipeline. Now, sure, buying a company that size does create some slight near-term earnings dilution, which explains that tiny trim we saw to their guidance recently. But it's a clear long-term play to make sure that cash flow machine keeps humming for years.
All right, let's pull this all together. If you want to see how this mystery actually resolves, here's your roadmap.
If you're tracking this stock, these are the critical catalyst dates you absolutely need to circle on your calendar. In fall 2026, we've got the U.S. regulatory decision for a new Skyrizi subcutaneous induction for Crohn's disease that should definitely boost market share. Then, late 2026 into early 2027 brings FDA decisions on Rinvoq for vitiligo and alopecia areata. Management thinks those indications alone could generate $2 billion in peak sales. But the absolute biggest catalyst hits in Q3 and Q4 of 2026. That's when we get the trial data for HS. If those readouts are clean and they dodge that GLP-1 noise we talked about, the pipeline story gets massive validation. And suddenly, paying a 70x multiple doesn't look so crazy after all.
Of course, we know not everyone wants to bet their portfolio on a single clinical trial readout. If you absolutely love the AbbVie growth story and how they've pivoted post-Humira, but you're a little spooked by that GLP-1 effect or just the idiosyncratic risk of holding a single pharma stock, there is a super practical alternative. You can always look at a diversified healthcare ETF, something like XLV. It gives you exposure to the broader sector's upside without staking the whole shebang on one company's specific pipeline data.
And that brings us to our final thought for today. This entire valuation puzzle really boils down to one thing. AbbVie is executing incredibly well right now. The cash flow is massive, and surviving the Humira transition is a huge success story. But ultimately, you have to decide, can this pipeline deliver tomorrow to actually justify that 70x premium price tag? If you believe in the cash flow story and you've got the stomach to hold through those data readouts, this is for sure one of the most compelling and unusual valuation spreads in the market right now. Thanks so much for joining me on this explainer, and definitely keep a close eye on that clinical data.